We continue with reactions to the latest GDP numbers that fell by 51%. Amongst the largest contributors of the fall in GDP were basic iron, metal product, machinery, food and petrol. Now joined by Chief Economist at Alexandra Forbes, Mr. Isaah Mhlanga. Good to have you with us, Mr. Mhlanga. Perhaps let's start with this question. The fact that even though and despite the fact that there has been a 51% contraction, there's also a very high debt to GDP ratio. What does this necessarily mean and what impact is this likely to have on our economy?
Look, I think firstly, we have to agree that this is something that already happened. We are now in the third quarter. These numbers are for the second quarter. But also we need to contextualize the 51% contraction. On a quarter-on-quarter basis, comparing second quarter with first quarter, it's 16% contraction. But if we take an annual equivalent, then it goes to 51%. But I think it is silly to annualize numbers in the middle of a depression because numbers are going to be very volatile. But also, if you take into account that in April and in part of May, we didn't have the ability to travel much more easily. And as a result, there is data imputations, which SSA has to do because some economic activity were completely shut down. So this data is subject to revision going forward, simply because of the times that we are in.
And Isaah, when it comes to what you have said in the past, I know that these are historical numbers for the second quarter, and we all know that there was no actually activity economically in the country. But looking at the sectors that are worrisome, we've seen the mining and manufacturing sectors again, not performing as expected. And we are looking at these sectors as, not sunrise sectors as they were in the past 20 years. Which sectors worry you the most when you look at this data for the second quarter?
Look, all the sectors are contracted except for agriculture, and that should concern us because it means it's not a sector specific, it's an economy-wide issue. But also, if you look from an expenditure side, household consumption expenditure contracted by 31%. That despite the support that government has provided to those that lost jobs, but also that's despite the fact that we still have some people that have jobs, but still we see that lack of consumer confidence in future prospects, making them to stay put and not spend on the big ticket items. This, for me, is a bigger concern. Despite the cut in interest rates from the central bank, despite the fact that banks have also instituted ways to help their customers by delaying repayment, still consumers are not willing to go out and spend. That just tells you how much lack of consumer confidence is in the economy, and that is a concerning feature. You look at gross fixed capital formation as well, 11.5% contraction. It just tells us that the future prospects of this economy or the recovery is going to be much slower than what we want it to be. So we can forget about a V-shaped recovery that is normally spoken about. It's going to take us a long time to regain this lost growth. And perhaps sometimes percentages, they conflate the numbers. Let's just talk in rand billions. What does this mean? The economy contracted by 512 billion in the second quarter compared to the first quarter, which is more than the fiscal package which National Treasury puts together. So what it means is that fiscal package nearly just offset the contraction that we saw in the second quarter. For the recovery, we need a whole new fiscal stimulus than the 500 billion that we provided with.
And what type of a fiscal stimulus would you anticipate or would you put forward?
Repeat?
What type of fiscal stimulus would you be advocating for?
Look, I think where we are, given that our debt to GDP ratio is expected to increase quite drastically, we need to do the economic reforms that makes the private sector to invest in the economy. Essentially, it should cost government very little financially because there is a lot of capital that is waiting to invest in some of the big projects. What it requires is a conducive environment. What it requires is corruption to be tackled. What it is required is a regulatory framework that makes it certain for businesses to come and invest, knowing that they're going to reap the return when the economy recovers. So it should really be very less costly for government financially, but government needs to do a lot more from a regulatory point of view to make sure that the investment climate is much more friendly.
Isaah, if you are an investor right now and you've got a ratings downgrade, you've got COVID-19 lockdown, you've got an economy that was already in recession beforehand, you've got all, with load shedding as well, you've got all these things coming to a head this year, and you're an investor wanting to pour money, what's your first thought about investing in a country, and what can government do actually besides those structural reforms to actually spur economic growth and those investments?
Firstly, if you think about long-term savings investors such as pension funds, insurance funds, the traditional investment universe, which is the listed market, has shrunk significantly over the past 20 years. For instance, in the early 90s, we had about 950 listed companies. Currently, we have just over 300 companies, which means that universe where you can put your money has decreased. Secondly, there is a significant concentration in the listed space. A few companies constitute the bulk of the JSE market capitalization. So what does this mean? There's a lot of value that is outside of the listed space, that is in the unlisted space where things like infrastructure are predominantly present, which is where I would want to go and harness those returns. So that's what I'm thinking to say, look beyond the listed market, and perhaps the infrastructure spend or the investment drive that government is driving coincide with my goals to enhance my returns, but also with the national goals to improve economic development of the country. So there is a meeting of minds and objectives for both the client and for government to the benefit of broader South Africans.
Just to pick up on what Xolani started asking there, with the current climate and the global climate as it is financially, with COVID-19 having depressed the entire world literally as far as the economy is concerned, where is one likely to find such bullish investors who at a time like this would be willing to perhaps not safeguard whatever little they may have and be willing to invest in a country such as South Africa that is having its fourth consecutive recession in a row?
Look, South Africa is not alone in this recession. All the countries globally that are suffering with this recession. The US contracted by some 30%. You look at countries like Germany, they contracted by some 12%. The UK by some 20%. So it is a global recession. It's not a South African recession. So everywhere you look, countries are dealing with the same conditions. And that said, there is a lot of funds and capital that is looking for spaces to generate return. So to the extent that you still continue to require that capital to give you a positive return, it has to find a home. And to that extent, we would need to actually look at those opportunities domestically.
And when it comes to going back to this particular GDP data for the second quarter, we saw that exports were actually also down tremendously. But we expected that since there wasn't enough or there was no activity in terms of exports of all goods, it was only essential goods. But exports going forward, what do you see?
Exports depend really largely on the recovery that we see externally, and to the extent that we know from the IMF forecasting, they're going to issue new forecast in October, which they have already indicated they're going to downwardly revise global growth yet again. And that just tells us that globally there's lack of demand. So the recovery in our exports is really hinged on the recovery in our trading partners. And as I said earlier, everybody is dealing with the same pandemic, same conditions in terms of recession, our exports are going to take a lot longer to actually recover.
And how long do you see this economic recovery taking? When do you believe that we're going to start perhaps equalizing and then turning the tide?
For the South African economy, if we contract this year by anywhere between 8% and 10%, it means we are likely to return back to 2019 levels of economic activity in 2023-2024. So that's some 3 years of lost economic activity. If we, however, see a deeper contraction for the year as a whole, let's take the national trade at a 16% contraction, worst case scenario. It's going to take us until 2027 to recover back to 2019 levels. So it's an extremely long period of time, and we will never, get back to the same trends that we were at before COVID-19, which means there's a permanent loss in income.
Certainly quite an extended recovery period there based on those projections. But we thank you so much for your insight and your contribution this afternoon, Mr. Mhlanga. You have yourself a great day ahead. That's Mr. Isaah Mhlanga there on his take regarding the economy and the second quarter GDP.